Hello, young entrepreneurs. Welcome back to your ABS short course on entrepreneurship. My name's Natalie, and today's topic is all about cash flow. And the very first thing I'm going to say is don't panic. Lots of people really worry about this when they're starting a business. And we come to this area of a course and people say, I don't do numbers, I don't want to do this, but it's really, really important. And you will see that it's very straightforward. So get ready. By the end of this session, you'll understand how money moves in and out of your business and how to plan like a pro. So what we're going to be learning today is, firstly, what is the cash flow? But also how you locate what your costs are, what your revenues are in a broader context. And then we're going to look at how you actually put those into a cash flow document. We're going to cover why it's so important for your business. And then at the end, we're going to look at a real cash flow document so you can actually see what that looks like once you plug it into a template. And then what you're going to do is go away and create your own cash flow forecast using the template. And you'll learn how to check your work and make sure that all your numbers are really clear. So question number one, what is cash flow? So we're really talking about the movement of money through your business. So you've got money that's coming into your business from selling something, and that's called an inflow. And then you've got the money that the business spends on all aspects of running your business and producing things, and that's called your outflow. So when you spend money on things like ingredients, transport, equipment, all of that is an outflow. And what the cash flow is showing us is what's coming in and what's going out. So why is cash flow important? Well, really, because it tells us if your business is healthy and if you'll have enough money to keep going. If you don't manage your cash flow, you could run out of money, even if your business is actually doing really well. So what it's doing, by monitoring your cash flow, you can ensure that your business can survive. Now, this is the bit that sometimes people feel confusing. They're like, well, how can I run out of money if my business is doing well? And a good example to think about is if you're setting up an event, for example. So you might know that your event is going to be really successful, that you're going to sell masses of tickets on the day. People are going to be spending lots of money when they're there. So you have no doubt that your event is going to be successful. However, in the run up to the event, you're going to need to spend lots of money putting deposits down for things, booking your venue, booking lights, all the different things that you need to get to put on a successful event, but you're not actually going to have any money coming in at that moment. So you could completely fail before your event has even happened. So by looking at your cash flow, you can identify, oh, hang on a minute, I'm going to need something to cover all that money before I perhaps sell all of my tickets. So what could you do? Perhaps you could have a special offer on. So if people buy, you quite often see early bird tickets. If you buy your ticket early, it's going to be slightly cheaper. But that means you've got some cash flow coming in to start paying some of those upfront costs. Or perhaps you identify that you're going to need to take out a loan or get a sponsor, or you can look at all the different options available. But the important thing is to understand where you may run out of money. So a really good cash flow plan helps you make smart decisions before there's a problem. So there's quite a few reasons why you need to produce that cash flow. So as we just talked about, it gives you that advance warning if you might have cash shortages. So it's giving you that early warning of when your money might run out. It makes sure that you can pay all of your suppliers and your team, your employees, which is really, really important to be able to plan for that. It means that you can identify if you've got some problems where perhaps customers aren't paying you on time and that's leading to problems in your cash flow. So you can try and get ahead of that and sort that out. It's a really important part of financial control. So it's helping you stay in control of your business. And it also shows banks and investors that you're serious and that you're prepared and that you understand that money that's going in and out of your business, you understand it and you're planning for it. Now, cash flow is really useful, as we just discussed, but it doesn't show you everything. So let's talk about what a cash flow doesn't tell you. So first of all, it doesn't tell you how much profit your business is making. So you might have lots of cash coming in, but if your costs are high, your profit could still be low. So profit is what's left after you've paid for everything else. So just because your cash flow looks good, it doesn't necessarily mean that your business is making a profit yet. Secondly, it doesn't show what your business owns. So you might own equipment, tools, machines, you might have stock, you might even have furniture or a laptop, things like that. That's not going to be reflected in your month by month cash flow because they're not things that you're buying and selling every month. And those assets may also be losing value over time, but that's not going to be showing in your cash flow. And finally, it doesn't necessarily show you what you still owe to other people. So loans that you need to pay back, money that you've borrowed from a friend or a family member, those are your liabilities, and they're really important for your business, but they're not always going to show on your cash flow right away. So there's plenty of other tools that can help you do that we're not going to go into today. So you have profit reports, balance sheets, all that sort of thing. Cash flow is more like a photo. So it's just showing you one part of the picture, really important part, and it shows you, importantly, that movement of cash in and out at a certain time. So it's a bit like checking your wallet or checking your mobile money balance to see how much you have today, but it doesn't necessarily tell you the whole picture. And there are other tools that you would use to do that. Okay, let's get into the two most important parts of cash flow, inflows and outflows. So that's the money coming in and the money going out. So let's start with our inflows. So that's all the money coming into your business. So where is that money coming from? So let's look at a few examples. So sales. Somebody's buying your product or your service, that's obviously money coming into your business. Or you could have investment. So someone could have given you money to help you grow your business. You might have loans from a bank or from a family member, or you could even have grants or prizes. So if you enter a business startup competition, for example, and you're successful, that might be money coming into your business. So we're going to use a really simple example. So you make handmade bracelets, you sell 10 handmade bracelets at $5 each. So that's $50 coming into your business. So that is your inflow. Right, so let's go on to outflows. So that's obviously the money going out of your business, and every business needs to spend money to run properly. That's absolutely okay. That's completely expected. The important thing is that you're aware of what money is going out and that you're keeping track of it. So the sort of things that outflows might include is buying materials to actually make something. You might be paying rent for a stall or a space that you're using. You might need to pay for transport if you need to deliver things. You might be paying wages if you've got somebody who's helping you out and working for you. And then you've got other things you mustn't forget about, things like electricity or data. You know, if you're using a mobile to run your business, or if you need internet, all of that are things that your business needs to pay for. So going back to our simple example with our bracelets, let's say we had to spend $10 on beads, $5 on string, $5 on transport. So therefore we've spent $20 in outflows. So our inflow was $50. We've spent, our outflow is $20. So what's left? $30. And what with that $30 is what we call our net cash flow. So that's your inflow minus your outflow. We're going to come on to that in more detail in a minute. So let's take a few examples. So if you're selling smoothies at $2 each, is that an inflow or an outflow? It's an inflow because you're getting the money for selling that product. You pay for mangoes and cups. Is that an inflow or an outflow? That's an outflow. That's you paying for the materials to make your product. You receive a grant from your school's business club. Is that an inflow or an outflow? And that's an inflow. That's money that's coming into your business. And then you pay your cousin to help you pack everything up before you ship it out. Is that an inflow or an outflow? That's an outflow. So that's wages that you're paying to your cousin. So remember, cash flow is coming in, cash flow goes out. And your job as an entrepreneur is to track both sides, make smart choices, and keep your cash flowing in the right direction. So there's one other thing we need to consider with our costs, with our outflows, and that's that some are what we call fixed and some are variable. So variable costs are the ones which will go up or down depending how much we're actually making. So let's look at fixed costs first of all. So these are costs that stay exactly the same no matter how much you sell. So you're going to be paying them every week or every month, whether your business is really busy or if business is really slow. So examples would be rent for your shop and stall. You might have to pay for that for a full year, so you're going to be paying exactly the same every month, regardless of how well your business is doing. You might have a monthly internet or phone bill. Again, exactly the same every month. If you've got full-time staff, that's a fixed cost because you know exactly how much you're going to be paying them every month. And things like insurance is normally a fixed cost as well. So those are the things that will cost the same regardless of how much you're selling or providing to other people. So they're things that even if you don't sell anything this week, you've still got to pay these things. And then we've got other costs, which are what we call variable costs. So they're going to change depending how much you sell or produce. So if you're making food, for example, the amount of ingredients that you're going to need to buy is dependent on how many cakes, for example, you're making, will determine how much flour, eggs, sugar you need to buy. The packaging for your products. If you're making more products, you're going to need to buy more packaging. The materials that you might be using to make clothes or crafts, you're going to need to buy more of those materials if you're making more of your product. And again, your transport costs might go up. If you're doing really well, you're selling lots of things, you're going to be needing to pay for more delivery costs. So if you sell more, you're spending more. And if you sell less, some of those costs might come down. And that's why we call them variable costs. So let's look at some examples. So let's think about whether these would be fixed or variable. So if you're buying fabric to sew 10 bags, that would be variable. If you're paying rent on your workspace, that would be fixed. You've got to pay the same thing because you're going to make that commitment upfront for a period of time. Paying your cousin occasionally because he sometimes helps you out at weekends, that's a variable cost. It's not going to be the same every single month. And then something like a monthly internet bill, that's a fixed cost. So knowing the difference between these costs helps you make better decisions. So if your sales drop suddenly, you can look at your variable costs and think, okay, well, these will come down, this one will come down, and you can sort of juggle things around a little bit and not impact your fixed costs. So when you create your cash flow forecast, it's really helpful to have a really good understanding of which of those costs are fixed and which are variable, so then you can plan accurately. Right, so now we're going to look at an actual cash flow forecast. Don't panic, I know there's lots of numbers on the screen, but we're going to talk them through. It's exactly what we've just talked about with our inflows, outflows, and our net cash flow. So let's see what it looks like. So typically when you see a cash flow forecast, you'll do it on a month-by-month basis. That's the best way to do it. Now in this little example, we're just looking at 3 months, but typically you'd see it for a year or even longer. But always with the same format, 1 column per month. Now at the top here, you can see the cash inflows. So exactly what we've talked about before, money coming into your business. So in this simple example, we've just got investment and we've got sales. Those are the 2 ways that money are coming in. Then we go on to the next section, we've got our cash outflows. So these are all the things that we're spending money on every month to run our business. So here we've got raw materials, wages and salaries, marketing, setup costs, other costs. And we'll come and look at those in a bit more detail in a moment. So then we've got our total outflows here. So we've got our total inflows at the top, total outflows underneath, and then our net cash flow. So the net cash flow is the difference between your inflow and your outflow. Then at the bottom here, we've got 2 other things. One is the opening balance. So that's how much money the business starts with at the beginning of the month. And then our closing balance is how much we're going to have at the end of the month after all these inflows and outflows. So it's your opening balance plus your net cash flow. So let's look at this example in a bit more detail. So we'll start off looking at January. So we can see here, this is a new business, it's just starting up. So month 1, you've got 10,000 in investment. Fantastic. So you've got that injection of money coming in to get you started. You've also got a small amount of sales. You're only just starting up, so you might be starting quite slowly, but you have got some money coming in from sales. So altogether, you've got 12,500 coming into the business in January. But let's look at what's going out. So you've had to spend 4,000 on raw materials, 3,500 on wages and salaries. You've got some marketing costs up front, and quite often when you're starting a business, those might be slightly higher because obviously nobody knows who you are. So you need to get your name out there. You've also got some setup costs. Now, you would hope, and you can see here in this example, those setup costs are going to be higher at the beginning, and then they should be going down. But you can see in this first month, you've got 3,000 going out in setup costs. And then you've got some other costs as well that would just all get added together into this row. So then if you add up all of those outflows, it comes to 15,000. So net cash flow, we've got 12,500 coming in, but we've got 15,000 going out. So that means in that first month, we're in minus 2,500. So that means overall, we've got more money going out of the business than we've got coming in. So our opening balance was 0 because we're just starting up. Our closing balance is minus 2,500. So going into February, we know our opening balance is that minus 2,500. So that's what we're starting off with. But this month we've made 10,000 in sales. So it's gone up a lot since January. So that's really good. So you've got 10,000 coming in, but we've still got all of these outflows. So perhaps spend a bit more on raw materials, a bit more on wages and salaries, a bit less on marketing this month because you've obviously launched. Setup costs are going down, but there's still some there, and other costs as well. So overall, we've had 12,000 going out of the business in February. So a bit less than in January, but obviously it's still quite a lot because you're just starting up. So we've had 10,000 coming in, 12,000 going out. So our net cash flow is minus 2,000 for February. So let's look at what our closing balance is going to be. So our opening balance was minus 2,500. That's where we were at the end of January. And then our net cash in February is minus another 2,000. So that leaves us with a closing balance of minus 4,500 by the end of February. Right, then we go on to March. So March, our sales have gone up again. So that's really good. So you can see that the business is growing. It's obviously getting well established, which is fantastic. So we've got 15,000 coming in March. And let's look at what's happening with our outflows. So 5,000 in raw materials, 4,000 in wages and salaries. So you can see that's stabilizing now from February. So that's settling down. Decided to spend a bit more on marketing this month, so 2,000 on marketing. We haven't got any setup costs anymore, and about 1,000 in other costs. So again, our total outflows in March is 12,000. So we had 15,000 coming in March, 12,000 going out. So our net cash flow in March is positive. So we've got 3,000 as our net cash flow position. So our opening balance in March was minus 4,500. So you remember that's where we were at the end of February. So minus 4,500. But now our net cash flow for March is 3,000, that positive figure. So that takes our closing balance to minus 1,500. So you can see in this example, we're only covering 3 months here, but the position is already changing in terms of our closing balance by the end of March. And you can imagine if that were to carry on for another few months, you'd hope that that net cash flow each month will continue to be positive. But that's why it's really important to look at it. And what you'll start to see and what you need to think about is if your sales are likely to be seasonal. So for a lot of businesses, perhaps you're likely to sell more in the summer or in winter. There might be peak periods where you would expect your sales to be going up. Remember, a lot of your variable costs will go up as well. But then you might have other months where you expect to be very quiet. It's very unusual for a business to sell exactly the same all year round. So you really need to think about those seasonal patterns, how that's going to impact the money coming in, how it's going to impact your variable costs. But you also need to think about those months where perhaps your sales are lower, but you've still got all those fixed costs. So what's that going to look like in terms of net cash flow in those months? So now your activity is you're going to compile a 3-year cash flow forecast for your business. So you're going to have a template to do that. So you can plug the figures into there. And you're going to look at the full 3 years. So in that example we just looked at, we were just looking at 3 months. You need to now expand that out for the full 3 years and really think about what's going to be different in the startup phase of your business. What's it going to look like based on the seasonal variations we just talked about, and where do you want to expect it to be in 3 years? So you need to use the template. You need to check your working, make sure it all actually adds up. And make sure that everything that you present is researched and can be referenced back to your plan. So what I quite often see when I see a business plan and a cash flow forecast is that in people's business plan, they're talking all about all this fantastic promotion and marketing that they're going to do and whatever else, but there's no mention of that in the cash flow forecast, for example. Or there might be figures in the cash flow forecast in terms of how much things are going to cost, what the premises are going to be, that doesn't tally with what's in the rest of the plan. So really make sure that it all just ties up and adds together. So you should be able to read the business plan, read about the things you're going to do, and directly see what that means in terms of your cash inflow and outflow on your cash flow forecast. And if you think that there's anything in your cash flow forecast that isn't obvious, then feel free to put notes on the document to explain where you've got that figure from and why you think that figure is relevant. Remember, you're always trying to make things really, really simple for a potential investor or anybody to understand. So just make it as clear as possible, explain where your numbers have come from, make it easy for them. So the template that you've got, I think will look quite like this. So it's just like the one that we just looked at on the previous slide, but it's just broken down into a little bit more detail. And it's also got some formulas in there that might help you. So you can see here at the top, inflow, exactly as we saw on the other one. So all the inflows at the top there. But what this has got is it's got a field over here where you can input what your selling price is going to be. And then when you put in your number of units sold, it's going to calculate what that income is for you. So that could be quite handy. And you've also got a row here, exactly like we saw on the other slide, for any investment that you might have. So you can see in this example, there's £1,500 investment in July. So that goes into there as well. And then you can see here in the, all of this is outflows, but it's been broken down into 2 sections. So the first one is what's called your overheads. So they're the expenses that you've got for running your business. And then you've got broken out here your product costs. So these are the costs that are directly related to how many units that you're selling. And again, you can put in some figures over here that should help you calculate that. So postage and packing, for example, in this example is going to cost £2 per unit sold. So that will work that all out for you based on how many you've put in up here in terms of how many are being sold. So these are your variable costs. So then you've got your total overheads, your total product costs, and then they get added together. So here where it says total cost, that's your total cash outflow basically. And then it's exactly the same. It's just put in a slightly different order. So opening balance, like we saw before. So that's the figure carried over from the month before. That's your starting position. You've got your net cash flow, which is your total inflow minus your total outflow to get that net cash flow per month. And then you've got your closing balance, exactly like we saw before, which is your opening balance added with your net cash flow to see where you are at the end of the month. So if we look here in August, your opening balance was 1,324. Your net cash flow for that month is negative, so you've got minus 1,066. So that means your closing balance at the end of August is £258. And there is some stuff at the bottom there about tracking your stock as well. Don't worry too much about that. You might also see some tabs on the template related to other financial templates. Don't worry about that either. Just focus on the cash flow that we've been through today. So it might look slightly different, but it's exactly what we talked about. Cash inflows, cash outflows, opening balance, net cash flow, and closing balance. So that's all you need to be thinking about. It's just a case of looking at your template, expanding it out for the full 3 years, and then just start to plug in all your figures, and it'll give you a really good tool to play with to see what it means for your business if you've got certain months where you expect sales to be lower, or if you've got certain months where you know you're going to be paying out more money. You can start to see what that's going to mean for your business over the full 3 years. So well done, everybody. That covers what we're going to do today on cash flow. So you've learned about how money moves through a business, so those inflows and outflows, why tracking it matters, and how to make your own forecast. So you're building real business skills here, which are going to be really invaluable. Don't shy away from cash flow. It's really, really important. And as you've seen, it's really not that difficult. Once you get your head around what's an inflow, what's an outflow, what's a fixed cost, what's a variable cost, it'll be really invaluable to you when you start your business and start planning it and start seeing what all the different scenarios look like. So good luck with everything. Keep up the amazing work, and good luck with all of your businesses. Bye.